It sort of gets to a point where you're just like, enough is enough. It's now or never. Don't have children. Not yet married. I've got 3 out of the 4 stars. This is it. When we set up 1st of November 22, interest rates blew out to, 5%, swap rates went to 6.5%. Real estate equity made 0 cents, made absolutely no sense.
Welcome to being an entrepreneur, Dean.
You've got to work 3 times harder, and you've got to be more resolute, and you've got to be relentless, and you've got to leave nothing to chance. I'm a big believer in that the investment market should follow the occupational market. So we only wanted to invest in those sectors. Starting your own business in a downturn, it can bring levels of anxiety and tough challenges. But I think knocking the alcohol on the head and getting up early just makes you feel like there's not much that you can't achieve.
Welcome back to another episode of the People, Property, Place podcast. My name is Matthew Watts. I'm your host, and I'm also the founder and managing director of Rockborn, an executive search firm giving real estate funds, owners, investors, and developers a difficult choice on who to hire. Thank you so much for returning back to the podcast if you're a regular listener, and welcome if you are new. Today, I am thrilled to be joined by Dean Harrison. Dean, welcome to the podcast.
Thank you very much for having me, Matt.
Not at all. Well, look, it's been quite a long time coming. You've been a very busy man, and it's been great to see. And I'm really excited to unpack a little bit about what you and the team at Harleyford Capital have been up to over the last nearly 3 years. But before we get on to some of that good stuff, can you just tell me a little bit about how and why you got into real estate in the first place?
Yes, I can give you a bit of background in that regard. I think taking a step back, originally it was looking like a career racing motorbikes. And after understanding that the risk reward proposition wasn't quite up to scratch, decided to go to university at the very much last minute to pursue business studies because I knew that one day I wanted to run my own business. And during that period, there was a gentleman in my village, and we perhaps won't get into why he needed a driver every Friday, but he did. And he asked me, given I had Fridays free from university, if I would be obliged to facilitate. And I did. And for a year, I drove around a gentleman called Jeff Penman, who has gone on to be I would say, very successful leading mid-box developer here in the UK, and really spending a year driving Jeff around, sometimes a little bit worse for wear, I think, after a Thursday at university, and seeing what Jeff did and how he went about it. I thought, this is potentially interesting. What is it you really do, Jeff, and how do I get into what it is that you do? And after spending some time with Jeff and his wife Catherine, they suggested that if I was serious about a career in real estate, that I should consider a place called Reading University for a master's. So in short, the sort of rest is history, but Jeff and I are still very much in contact, and forever grateful for my time with Jeff.
So no parents or family in the real estate game?
No parents or family had been to uni. That was a bit of a bit unusual, I suppose,
so you
for the
were
family.
First?
Yeah, first to go to university. So yeah, exactly.
So just on the motorbike thing, you raced motorbikes growing up?
Yes. So the background there is his father and uncle were both GP motorbike racers, professionals for a long period of time, and we had a national circuit on the family farm. So a lot of my youth was spent there with motorbikes and racing around the circuit, with a view to sort of probably following in their footpaths. But as I'd suggested, a couple of accidents later, and understanding how much these guys were earning, I was like, I'm not sure I'm up for this. And
the fact you're probably north of 6'5".
Yeah, exactly. I wasn't really built for racing motorbikes, but a lot of fun nonetheless, and some good life skills learnt during that process.
So business, and then going around, I'm assuming, looking at land, looking at development opportunities, looking at standing stock,
all sorts, yeah, very much.
Debriefing or hearing phone calls in the back of the car.
Yes, yeah, exactly. In the back of the car, Jeff was never too keen to sit up front with me. But I liked what I saw. And when Jeff set up, he was very much by himself, I would say. So very entrepreneurial in that regard, and took a liking and thought this made quite a lot of sense in terms of pursuing further. And I think, there's another aspect linked to that, is that without getting into too much detail, the family farm was in a relatively strategic location. And I think what became quite clear to me is that no one in the family really understood the complexity around bringing that land forward for future development purposes. So there was an aspect there where it was like, okay, someone in the family needs to understand what's going on here. It's a property game. And here, is an interesting route through going to Reading, doing a master's, going on to becoming a chartered surveyor, that would enable me to essentially understand that further and help that delivery over the next 20 years.
Makes sense. Did Jeff have his eye on the family farm?
No.
It wasn't, I'll give you a job, in terms of kind of getting an inside track.
No, I think Jeff's is a deal doer, and I'm sure at some point he might have asked me about it, and at some point I'm sure I've asked him about it. That's just, I think that's just the nature of being an investment professional.
You left Reading Uni in 2009.
Yeah.
So you left your business degree in 2007, left your master's in 2009, and you landed at Cushman's, if I'm not mistaken, in March 2010. You must have been well aware of the challenges coming out of university due to the global financial crisis.
Absolutely. But I remember being up for it, if that sort of makes sense. Academia hadn't been my strong point because I hadn't applied myself, really hadn't applied myself, but it was there. And went to Leicester for my undergrad, managed to get a first and thought, okay, actually I can do this academic side. Then went on to Reading, and there was an element of, if I don't get a distinction on this course, then that will undermine the first that I got. And I just got it in my head that I had to get a distinction. And at that time, the market was blowing up. So I suppose where I'd found myself was coming off the back of that course, having done well, not being many jobs available, but actually off the back of strong performance and my 2 degrees, was able to get the job that I wanted. I think there's another element to that as well, and somebody else that I'm not particularly close with, but I think it's quite vivid in my memory, is my lecturer for real estate securities at the time was a gentleman called Simon Martin, who's a senior individual partner at Tristan Capital Partners, and he'd come back to lecture, and I would say he probably was in his late 30s. And that's where my career started to take a bit of a change, moving away from property and development aspirations, more moving towards, say, private equity and investment banking. I remember him coming in, and I sense and I understand that he was taking a step back after perhaps a number of successful years riding the, should we call it, debt-fueled commercial property boom, maybe, and had some successful times in the ventures that he was undertaking. And I remember sitting through those lectures and thinking, I want to do what this guy's doing. This is it. This is exactly what I want to do. So I remember having a chat with him at the time, saying, this is what I want to do. How do I get there? And he advised me to go and do my IMC, which I wasn't aware of at the time, but it was just investment management certificate. But basically sort of demonstrates a level of competence around financial markets. So whilst the market was starting to blow up, that I was totally unaware of, if I'm being honest. Not totally unaware, but I think it's fair to say I was probably having a lot of fun at university, and it's not something that you're overly concerned about when you're early 20s and with all your mates having a good time. But I got the IMC done, had a good run on the master's course, and that, was I lucky? I don't know, but I got the job that I wanted. That was corporate finance. Basically, corporate finance, real estate. That was, for me, a clear pathway into private equity and investment banking off the back of finishing that. So, yeah, into Cushman's, 3 9-10 month rotations around real estate corporate finance. Super interesting, good times.
I'm getting a couple of things from you. One is, always wanting to run your own business. The second, quite financially driven and orientated to earn good money at a relatively young age. Is that fair?
Yeah, absolutely.
And why?
There's no disputing that. I think there was just quite early doors a reality that was, things were expensive. If you want to acquire these things, you need to make quite a bit of money. I remember I did trot down to Sandhurst when I was 18 and consider a career in the military. And again, it was a bit like the motocross career. I was like, okay, well, what do you guys earn? And, what are you going to earn in 3? And I was like, risk return again. You're not quite stacking up here. And I've always had a preference for the numbers side of things. You
did nearly 3 years at Kushin Wakefield as a financial analyst, as you touched on. Did that cement your desire to go down that private equity and investment management route? Absolutely.
Yeah, I really enjoyed it. I mean, typically in the corporate finance team, it was just a great team of individuals. Luca Giangolini, Ed Daubeny. It's just a great bunch of guys that really enjoyed working with. Anything relatively complicated would end up in the corporate finance team. If it was straightforward, it'd end up elsewhere. But if there was complexity, and particularly moving into the GFC, there was a lot of distress, a lot of complex stuff floating around. So to get exposure across 3 sections of, call it, corporate finance, investment management, with everything was interesting. So for me, I was like, we're in a good spot here.
Yeah, I certainly remember when I was a headhunter starting out, we used to love trying to pull the analysts out of the Kushin Wakefields and CBREs and Knight Frank corporate finance teams and go and place them, on the principal side.
Exactly.
And I think you did just that coming up to 3 years. You decided to move and you went to infrared. Why was that?
It was what I wanted to do. It was private equity. I'd sort of seen what Simon Martin had done, and this was a logical next step. Small numbers of people, big numbers, and an anticipation of getting drilled, which that's what I wanted. I wanted to get stuck in and have heaps of responsibility and sink or swim. And with Infrared, absolutely, we got that. Infrared Capital Partners was founded in 2011. I think I joined in 2012. It's a management buyout from HSBC Specialist Investment, and super interesting at the time, very top heavy. So it was a buyout, I would say, by 30 senior employees, partner level, but with no juniors. So I think when I joined, might have been there was one analyst, me, and then maybe one VP and 7 partners covering 4 major European countries. So I was having my arms and legs pulled off. Eventually, the pyramid sort of became inversed, and it represented more of a sort of traditional private equity shop with more analysts and slightly fewer associates, slightly fewer VPs, and as you sort of got up the hierarchy. But for 3 or 4 years, it was super intense, but a lot of fun. A lot of deals, good guys, good team. Yeah, and a lot of fun was had there over the 10 years.
Why do you think they hired you over anyone else?
I would like to think that they needed someone that they were going to sweat really hard.
And you were up for it.
And they were like, this guy, he's really keen, and we're going to work him super hard.
Glutton for punishment. Yeah. Farming background.
Yeah,
exactly. He's prepared to get up early. And
yeah, I think they'd see a small amount of track record over the last 5 years through the academia side, and probably sort of see that I got clear direction and was hungry and up for it. My Excel modelling skills had also become good. And that was something I really focused on at Cushman's corporate finance. And as part of all of these tests, when you're being interviewed, the Excel modelling test is critical. And I think they had a look at that and was like, okay, we're going to sweat this guy hard, and he can model. So that was certainly useful skill sets, and they are still skill sets that I and the team at Harleyford, we are looking for. And Zane, who founded Harleyford with Tom and I. I hired him from Cambridge 6 years ago, and I sweat him hard. He's been through the same regime, as have a number of others, and he's still with us today. And we're actually looking for the next person to come in and slot in under Zane to do it all again.
Before we come on to Harleyford, tell me about some of the deals, some of the asset classes, types of deals and locations that you're operating on at Infrared.
Yeah, so from Infrared European real estate team, it was pan-European real estate private equity, typically value-add opportunistic, but did have a number of core funds, discretionary capital, typically raising anywhere between 3 and 500 million of discretionary equity, leveraging that up to north of $1 billion. And there was, I would call it, maybe 5 to 10 investment professionals, including investment directors and senior asset managers responsible for deploying and managing those assets. And in terms of where did we invest that money, it was across platform building and aggregating. We did a lot of that in the logistics space for sure. Spec development, backing operating partners, funding of developments, clever special sits deals, planning orientated deals. So with that experience, we just got so much exposure, and being such a small team, it was a lot of fun, but incredibly rewarding in that regard. And the European real estate team has subsequently sort of moved on to pastures new, but a lot of those senior figures are very much present in the market today. We've got James Cooper at Ingeren, Gareth Purcell at BGO, and Fabian Lang at Harrison Street, and Phil Cridge, and we still talk, and we've got fond memories of those times together.
You rose up the ranks relatively quickly because you had a 10-year tenure at Infrared. Was it the intensity of the business and the variety that kept you, because you felt like you were always learning?
Yes, and the unrivaled levels of responsibility, I think as I was getting more senior, and of course it was a great market to be in. We forget, and perhaps we'll touch upon this later, but from 2010 to 2022, we just had major cap rate compression, and everyone was living the dream, basically. And that was my key sort of tenure at Infrared, where yes, it was really hard work, but fundamentally it was, generally speaking, good news across the board as a result of that cap rate compression. So more money flowing into the market, bigger funds being raised, more capital to deploy, bigger profits being made. This is sort of the good times. I think things are very different now. We'll talk about that shortly, no doubt. As I became more senior, there became less people between myself and the coal face and undertaking those transactions. And towards the end was responsible for UK investment origination and execution, and since 2018 conducted north of $1 billion of discretionary capital transactions. So super rewarding in that regard. And that's where Tom, Zane and I got to become good friends. In the trenches, weekends, late at night, I would originate, execute, Zane would support, we'd hand over to Tom, Tom would asset manage. But the three of us became incredibly close, and that's where we, I think, became friends, and built that strong bond where I knew that, these guys were suitable. More than suitable. These were the guys that, if I was going to do my own thing, it was with these guys.
What was it that you identified in Zane and Tom specifically that you could relate to, or there was that je ne sais quoi about them that you liked?
Well, I think, first of all, and those that know me, I can be very difficult to please and overly critical, very difficult, and even when marking my own homework in that regard. And I think three characteristics I think are absolutely crucial, and we look for in people that we're going to hire into Harleyford to create that culture that we want. And I think one is intellect. We're looking for top 5%. Two is self-awareness, EQ, emotional intelligence. There's a lot of intelligent people out there with IQ lacking on the latter. And the third is determination and drive and the willingness to want to work hard. I don't think you can teach that. I think you've either got it or you haven't. And I think in Tom and Zane, having spent 6 years, brought Tom into the business. We worked together for 6, and then hired Zane out of Cambridge in probably 4 or 5. By the end, with those 2, it was clear to me that they had all of those 3 things in abundance. And I did not need to be present at any point to, worry about what they were doing, thinking, or saying. In fact, I would be fully in agreement every time. I never even sort of ever had to question it. And that, I think, is quite rare. So that was good enough for me.
Obviously, at Infrared, you were on the kind of the LP or the capital allocation side. At Harleyford, you set up an operating business or a GP business. What did you learn being on the LP side that informed, or about the relationship between LPs and GPs, and how you could improve or what you looked for in a partner?
So I think from the Infrared Capital Partners perspective, we had the financial understanding and the sophistication just by virtue of the role that we were fulfilling. And from an Infrared perspective, they were very much bottom-up real estate orientated as well as top-down macro market fundamentals. So from that aspect, we got the property element, we got the financial acumen perspective. And in a lot of cases, we would be backing operating partners or joint venture partners. And I think what we saw in a lot of cases was they had good fundamentals with regards to the real estate, but had a lack of sophistication in terms of engaging with the GP or the fund manager, and the delivery and the quality of that information. So taking a step back, I'm a chartered surveyor by trade. Tom is also a chartered surveyor. Zane is a chartered financial analyst. But we felt that we had the ability to sort of step down, have the ability to undertake real estate asset and development management side of things, whilst also making the lives of people that do the role that I used to do, considerably easier. And one of the things that we would find at Infrared, I could probably only run a deal at a time or 2 deals at a time, maybe run 2 deals at a time and looking at a new deal, because I've got a bandwidth issue. We can only transact so much. And a lot of that is because of, quite a bit of heavy lifting you have to do from the operating partner side to get to the bottom of the due diligence and get to the real crux of the problem. And, where does the Harleyford USP come in? Then, okay, we've stepped down a level. But what we could see is there were a number of our competitors. It might be Lone Star, for example, Tristan Capital Partners, or could be ICG or Naveen. But these are places that manage significant amounts of capital with not many people that are time poor. And from a Harleyford perspective, that's our USP. One of our USPs is that we're able to identify an opportunity, conduct the red flag due diligence, underwrite it accordingly, ask the right kind of questions, negotiate, structure the deal, and then make a phone call and pick the phone up and say, hey, I've kicked the tires on this and this is interesting. And then, okay, Dean, great to hear from you. Drop me an email. And then it all lands nicely wrapped in a bow, very easily digestible in the same language that some of these major GPs that are time poor lands in their inbox and makes their life super easy. And I think we're getting to a point now at Harleyford where I think we're proving that case. So, it's working out positively in that regard.
There's not like a translation issue from kind of fund manager to operating partner because you speak the same language.
Exactly.
You've been in the same seat. You see how they would underwrite or look at deals and, as you said, look for the red flags.
There was an element of just saying, well, when I was sat in that seat, what did I find frustrating? What was annoying to me? And with that in mind, from a Harleyford perspective, we were able to address all of that and make things super digestible, super efficient, and good quality, high quality work, and actually do a lot of the legwork that takes a lot of time, to get into a position to secure off-market deal flow.
You touched on earlier in our conversation the desire to run your own business at one particular stage, and you obviously studied business at university, which is probably a nod towards that. At this stage, or by this stage, I should say, you had probably been coming up to nearly 15 years worth of experience, professional career.
Yeah.
Why did you decide to take the plunge and launch your own business?
I think, I've been wanting to do it probably since 31, 32. And I suspect this is a common theme. There's a lot of naysayers. Oh, you need to find the capital first. Oh, you need to find the deal. Oh, you don't want to do it by yourself. And this goes on, and you're like, oh, you could just do with a bit more experience. You need a bit more experience. And you're like, okay, all right, okay, yeah, makes sense. And to be fair, my career at Infrared was going from strength to strength, and the work was probably getting more interesting. But we got to a point, where it's like, okay, I'm 37, I'm not yet married, and I don't yet have children. Things are changing positively, and I'm was also cognizant of how people's personal circumstances change once they get married and once they have children. And it just got to the point where I was like, okay, I've got 4 key things that you would ideally like. You'd find the right people. Okay, have you found the right people? You would have a seed investor capital backer. Okay, have I got that? You would have a seed deal. Yeah, we've got that. Yeah. I would have some startup capital as well, but I need some working capital to get me going. And I think there's an element of you wanting to try and line up all 4 or 5 stars. Yeah, that's like a needle in a haystack. We'd all like that
while you're working at the same time.
Yeah, we'd all like that, and it sort of gets to a point where you just like, enough is enough. I've got 3 out of 4. Yeah, and okay, we don't have a capital backer, but we can do this. We can do this. It's now or never. Don't have children. Not yet married. I've got 3 out of the 4 stars. Yeah, this is it. Yeah, and really, that's where Harleyford was formed.
So you're working full time. It sounds like you'd kind of lined 3 of these things up at the same time. Is that right?
Yes, yes and no. Partly by accident. I think towing the line. No, to the extent, I was clearly employed by Infrared Capital Partners, but let's just touch on the 3 things that, we did have going for us. I had the people. That was, there was no questions around that. I said I had the people. I didn't have the people, but I knew who those people were. We did have a seed deal of sorts. The sort of family farm that I referenced in the 20-year journey, we were successful in securing a residential planning consent for a significant number of homes back in 2018, which, for the benefit of hindsight, was positive, and we exited to a consortium of national PLC house builders. And off the back of that, we were then able to roll some proceeds into farmland that we had retained and secured a commercial planning consent for a not insignificant amount of warehousing within the Golden Triangle. And that materialised. That was off the back of 15 years of planning promotion. It just happens in the background. It doesn't happen overnight. It's not something where I'm going to do this tomorrow and get it done. It just materialises inch by inch. We're all aware of the UK planning policy and its issues. So that had arisen, and no idea what would happen with it. But it was like, well, we're going to be doing something with it, and I'm really busy with work on a day-to-day basis. But there's something to potentially do there. I don't know in what form, and I'd been busy saving over a period of time and set aside some capital that meant that I was I didn't have to worry about a roof over my head for a period of time. So with those 3 things in mind, I think puts you in good stead to sort of have that it's now or never conversation.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. How did you actually get the business off the ground? Because was it a case of like resignation? home, flat, house, phone and laptop. I know you touched on the fact you had a few things in your favour. The one thing you didn't have in terms of the four things was kind of working, maybe external capital to fund the business. You probably had the working capital that you'd saved over the last couple of years.
Yeah,
how did you actually...
Or an investor as such.
Investor
that was the key.
That
was the thing. At the time, and hindsight's a wonderful thing, I was less concerned. Yeah. When we'd resigned, it was Q1 22, and we've been thinking about it, Q4 21. And
which at the time, post-COVID, markets on the up.
Exactly. Interest rates are rock bottom. Real estate is flavour of the month or flavour of the year in terms of asset class against bonds and equities. Money's piling in. I did not have any concerns about being able to walk into 3 or 4 blue chip investors and secure some form of backing or funding to go and do that. So with that in mind, it was like, okay, let's get going. And that's really where I think the Fier piece sort of comes into fore. We were very much out the door and heading to go and do our own thing. And Charlie Allen had become a friend, an industry friend, I would say, over 7 years previous. We would catch up regularly and discuss the market. And I'd taken a liking to Charlie, and we enjoyed each other's company. Charlie had said, well, hang on a minute. We at Fier, which is the former Palmer Capital business, we might have another option for you here, which is basically some VC funding in return for a significant minority stake within the business. And without getting into too much detail, we thought, okay, that could be interesting because it was an accelerator. It was an element of, okay, this is going to take time. We've got to get an office. We've got to start from scratch. We've got to do all of these things. And I think there's a number of reasons that we opted to go with Fier, and all are as important as one another. We got to know them and did we like them? Yes, we really liked them. We thought it would be a good team fit and culture-wise. They had a discretionary funding line in the form of the Fier Logistics Development Vehicle. And attractively, there's deal-by-deal promotes, which is something that I had fallen out of favour with from the commingled, cross-collateralised private equity funds, where they're not deal-by-deal promotes. You only get paid at the back end when the last asset is sold. Operating partners are operating on a deal-by-deal promote. And without spending too much time dwelling on that, it was kind of a way that we wanted to pivot Harleyford more towards. It was a business model that I think we thought was more attractive to us. So Charlie made us an offer and a proposition, and we thought this is a good idea to accelerate us forward by 2 or 3 years, which is valuable. And at the same time, the market was starting to turn, basically. And I don't think it was really that pressing because it was a bit of a slow move. I would say Q1 22 into Q2, oh, what's going on here? Is pricing starting to drift? Oh, Q3, there's some real sort of nervousness here. Inflation figures are starting to come out that are punchy. And then there starts to be a lot of chat about interest rate rises that are coming down the track. So, and I think in a rising market, it's very easy to say, I don't want to take third-party investment. I can do this. Why would I want to give any equity away in the business? Very easy to say that. Turn it on its head at the bottom of the market, to have that sort of, support, the framework, call it the comfort blanket, and a discretionary funding line to get you going from day one when the capital is ripped out of the market. When we set up 1st of November 22, I don't know what day the mini budget was. It's like 2 weeks later. It's like, welcome to work, guys. Interest rates blew out to, 5% swap rates went to 6.5%. Real estate equity made 0 cents, made absolutely no sense. It's like you went from being the asset class that is flavour of the decade, where all money is trying to get into because it's an attractive spread over gilts, and I want some of that spread, to why on earth would I do real estate equity investing unless there's distress and blood on the streets?
Welcome to being an entrepreneur, Dean.
Yeah, that was a punch down.
Yeah,
exactly. That was a reality check. And of course, Tom Zane and I, wouldn't have just been me. We were chomping at the bit to get going. We've come out of the stables and we are like, yeah, we hit the ground running. We're ready to go. Whilst the market just completely stagnates, the market doesn't correct overnight. The equity markets did, but the private markets don't. And, for the next 15 months, so when are we into now? 2023, whole of 2023, you couldn't put anything under offer because it was being repriced every month, basically. There was a huge bid-ask spread between buyers and sellers. So I remember we're 14 months in and, you're looking in the mirror and I'm like, I need more performance. This is not going to plan. Yeah, this can't fail. I've sort of said to Tom saying, we're going to be fine. Yeah, we're going to do this, and this is not going to plan. And I remember thinking, I need more. How am I going to get more out of productivity? And it was an interesting point actually. It did change something, and I know it's a bit of a cliche, but basically started getting up at like 4:30 every day, and I go to bed earlier. And I don't want to get stuck into, why is that benefiting you? But in short, I think you're basically just swapping unproductive hours in the evening where, what are you really doing after 7:00? You might be watching a bit of TV and stuff like that for these amazingly productive hours starting at 5 or 4:45 or 4:30, whatever. Yeah, where there's no one else awake. It's one-way traffic. You get pure clarity of thought, every morning. And you're clearing your inbox and you're getting all that strategic stuff done before the world is even awake. And for me, that was a game changer. I think historically I was only ever operating at 80%. I used to like drinking and partying, and that impacted performance. And I was leaving without a shadow of a doubt 20% on the table, 25% on the table, being a bit dusty on Mondays. Sunday a bit of a write-off. And that has certainly helped change things. And I saw a marked improvement in terms of Harleyford's ability to be able to push forward in super challenging times.
Control the controllables and do what you can do to try and outwork the challenging market. And I had an email from you at 5:29 this morning, so it wasn't like it was just a 6-week thing. You've clearly kept it up, and I know you've got a 7-month-old, and that brings with it its own challenges, being up in the night as well. But
yes, it does. I have an incredibly supportive partner in Jace, my fiance. She's absolutely amazing, and she's in on this journey as well. I don't think there's any disputing that you need that support. And another aspect is basically stopped drinking sort of 6-7 months ago. But
have you been sober since?
Yes, and I can say it's pretty liberating. I think you combine the sort of getting up at 4:30, with not drinking. It's pretty liberating in that uptick in performance, which has been great actually. You don't with starting your own business in a downturn, it can bring levels of anxiety and tough challenges. But I think knocking the alcohol on the head and getting up early just makes you feel like there's not much that you can't achieve.
When did you get your first break?
The first break would have been Fier. And you never know how these things are going to work out. You can find yourself with paralysis by analysis. At some point, you've got to make the decision. We decided that we thought Fier was a good fit for us and would accelerate our business forward. And in February 24, after 12 long, hard months of working away on a tough and complex office to logistics planning gain spec logistics development deal, we contracted that in February 24, and it was not insignificant. You're probably talking the best part of 65 mil of capital to deploy, and a planning gain strategy in there to boot. And that was funded by the Fier Real Estate Logistics Development Fund. So huge vote of confidence, got us up and running, first deal on the books, planning application in, that I think a lot of people on the face of it would have thought, was risky. We had DD'd it to the nth degree and got ourselves comfortable with the planning policy position and actually felt that it was very low risk. And we felt that we, had It was priced appropriately, reflecting that perceived planning risk, but ultimately our DD came good, and we secured that planning consent on time and in budget, and are just about to start on site with the construction, and that snowball effect. I think it does exist. People are like, okay, here's a business set up, said they were going to have a go at it, and now they're busy deploying 65 mil for their first deal, backed by institutional investors. So for us, that was a relief. And since Feb 24, we've put over 250 million to work across 8 transactions, 7 off market, across 3 leading blue chip investors. One you'll be aware of from the press, Tristan Capital Partners, which was strange, great to reconnect with Simon Martin. These things full circle. Another is a leading FTSE 100 business, and then Fier in total have allocated approximately 85 million across 2 transactions. And then finally to that, we've got 3 deals in legals with another global blue chip institution. So the last 18 months, I've been full on, and I think from a Harleyford perspective, it's keep our heads down, keep doing what we're doing, resource up accordingly.
You just hired Tom Goff?
We have just hired Tom Goff. So I did my grad scheme with Tom Goff at Cushman's. There was 2 seats going for the corporate finance grad scheme. Tom was the other one. So it's amazing how these things come around. We were confident, of the team fit, high levels of intelligence, emotionally aware, and driven and hungry for it. So, a great addition to the team. But for us, it's interesting because when we started, Tom Mallandine, head of asset management, no assets to manage. So he was a great resource to help us on the business development, and acquisition front. He is now snowed, very, very busy. So Tom Goff coming on board to help across asset management, existing deals on the books, and new acquisitions. Basically just a good solid pair of hands to help where required.
Was the idea always to go down the kind of the logistics route with Harleyford? Because on your website, you talk about new economy real estate. Does that give you the flexibility to kind of pivot?
Absolutely.
Depending on where the opportunity set is?
So if we take a step back, Harleyford aims to be a best-in-class investment manager and operating partner across new economy real estate. And when we say new economy real estate, it's real estate backed by megatrends, science or tech. And taking that one step further, it's real estate with strong occupational dynamics, good supply-demand fundamentals, with a very positive, favourable outlook. I'm a big believer in that the investment market should follow the occupational market. So we only wanted to invest in those sectors. In the challenging equity raising environment, we thought we'd better start with where we've got a strong track record. Now, we had transacted the best part of $1 billion of urban logistics, probably in the last 4 or 5 years at our time at Infrared, in the UK. So it was like, okay, we have a great track record in urban logistics in the UK. We better start there. And that was a sector we had very high conviction on, having been very active in the logistics sector since 2012, e-fulfillment, regional big box, then into urban. Sold a couple of platforms to Blackstone, the last one being Project Vantage in 2021. We could see, without getting into too much detail, that supply-demand dynamics and rental growth outperformance for urban logistics, we had high conviction on that. So we said, let's start there. And because if we can't have success in this market, things aren't looking favourable. So yes, that has been the sector we've started with, and we are operational across 3 or 4 strands. Speculative logistics development with Fier, including planning gain. Aggregating standing assets and platform building with institutional investors, including Tristan Capital Partners in the value add opportunity space. Special situations, big, large, complex deals where Harleyford have a bit of an angle. We recently closed a significant million square foot plus special situation deal, fully off market, sourced exclusively by Harleyford. And then latterly more in the sort of core plus urban logistics standing stock space. So we are finding ourselves very active. quite well covered in that market. And from a business objective perspective, we are very keen to start looking at what sector is next, whether that be ESG offices that I feel pretty passionately about as a sector that has been oversold and looks pretty attractive and pretty compelling, as well as later living.
You've spoken about them before.
We have, indeed.
So looking at what the plan is moving forward, I recall a conversation, I'm not entirely sure when the date was, but it was certainly, I think, pre your first deal. And you're talking about the challenges, but how you'd much rather a really challenging fundraising environment, having, and the ability to raise the money rather than raise the money a couple of years ago, deploy a load of money and be, shoot your track record, straight in the foot.
Exactly.
What advice would you give to someone who is on a similar journey to you right now? It
was a positive aspect I always came back to. I was unequivocal about it. I totally believed it. If I could take a step back and start a business, at what point in the cycle, all assuming that property markets are cyclical and interest rates and inflation and so forth, at what point in that cycle do I want to start that business? I probably want to start it 6 months before the world blows up and start investing towards the bottom. When would I not want to start the business? I would not want to start the business 2 years prior to the top of the market and get deploy a lot of capital, track record, shop, legacy assets, no performance fees, and generally it's going to be it's going to be pretty tough going. The double-edged sword aspect is I want to start at the bottom when the world's blowing up and no one likes real estate and it's out of flavour. Tick, we've got that bit done. Now try and go and raise the money. That's the double-edged sword. You've got to work 3 times harder, and you've got to be more resolute, and you've got to be relentless, and you've got to leave nothing to chance. I mean, it's meticulous. And that is the double-edged sword. And I'm not getting ahead of ourselves. Like I say, keep our heads down, keep doing what we're doing. We believe in the service that we offer. We believe that we are providing that best-in-class service, and I think that's testament with the blue-chip counterparties that are backing us. Keep doing what we're doing, and I think things are looking positive going forward.
What do you look for in an institutional blue-chip capital partner?
It's a number of things. Okay, first of all, they've got to be well capitalised. Critical. And not that obvious right now. It's not pretty out there. There are a handful of the big guys that are still able to raise capital. These guys probably own their own insurance companies or life insurance vehicles, are able to still allocate capital, or they're able to leverage relationships across other sections of the business. There are a lot that just can't raise right now. So 1, are you well capitalised and do you have capital? 2, are you nice people? We want to work with people we like, and not everyone's like that. So that's a huge thing. And the third aspect is need to be a bit more leaning towards asset allocation, as opposed to having a really big real estate department, because the inevitable question comes: what do I need you guys? And that's what we found in Tristan Capital Partners. Ticked every box. Great, really love working with the team, and they're incredibly successful, at raising capital. So really enjoyed that relationship and continue to enjoy that relationship.
You touched on senior housing as a potential strand that you're looking into. How do you, Tom and Zane, look at growth, and what does the future for Harleyford Capital look like?
So taking a step back, when Tom, Zane and I set the business up, we felt that we were young enough to set 10, 15-year goal around growing real enterprise value. And with that comes AUM, and with that comes new sectors. But absolutely critically, we need to be able to continue to deliver that best-in-class service in the Harleyford way that has its roots back to Infrared Capital Partners. So now we are transitioning a little bit at year 3, where we're now hiring. So we've got a new joiner analyst joining us straight out of Cambridge from the master's course in September to start backfilling some of the analyst sort of function. Tom Goff has come on board as a senior individual and a solid pair of hands to come and help with senior initiatives. And going forward, what we're not in the game of is creating conflicts of interest. We come from that institutional background. So when we look at UK urban logistics, we've probably got 4 offerings: special situations, value add opportunistic platform building, core plus, core plus standing operational assets, and spec development. Once we're operational in those 4 markets, there's not much else for us to do. So then we're into next sector. And that is on my agenda. It's been on my personal annual objectives to push on with that, but keep tackling the low-hanging fruit and get these new joiners on board. But for us, it's looking at opening up that new sector. So something Harleyford are looking for and would encourage. If there's any leading young, hungry, entrepreneurial, young but experienced, best-in-class operators, either in the ESG office space or the later living, that would potentially consider a more sort of entrepreneurial route. And I think that's important because, we're overlaying the Harleyford institutional processes and approach to due diligence and sourcing off-market product, with the deep-rooted expertise of a sector-specific individual. And we are looking for someone like that to join the business. And I think when you combine those 2 aspects, we've got a really compelling case for new capital wanting to get into those sectors. And the quicker we can look to do that, the better. But first and foremost, we've got to make sure that what we're doing currently is holding up to standards and scrutiny, and critically the asset management and the development management piece is rock solid.
Is the view to then have Harleyford Capital and then various different platforms servicing geographies and asset classes within that, with kind of leaders appointed as kind of MDs?
That's exactly right. The idea is then a Tristan Capital Partners or a Naveen or a Fier can come to a one-stop shop where they are getting that institutional service from a process perspective and an underwrite and delivery perspective and that off-market deal flow. But they can also get exposure to the differing sort of new economy sectors and that rental growth outperformance that's been identified by Harleyford. And that is the end goal. I think that's where we start to grow that sort of enterprise value, shall we call it, so that a single investor can come and we can offer them 3 or 4 risk profile of projects, spec development, platform building, special sits under each umbrella strand.
New economy real estate with the new kind of investment management platform structure to be able to take advantage of the opportunity set in the market. I like it a lot. As we draw to a close, the question I ask everyone on the podcast, Dean, is if I was to give you £500 million worth of capital, how would you allocate it? And I think I might know your answer here.
Well, I think let's take two takes on it, because I think one just sets the context for the environment that we're in. If you're saying you're giving it to me and it's me personally, I suppose, what are my investment objectives? Well, it's pretty patient capital. Maybe I'm sort of 15, 20-year time horizon. I'm relatively risk averse, and I'm probably not using leverage. And with that in mind, there'll be a lot of people out there that have their ISA allocations and so forth, but I'd never bought treasuries before or gilts. Ever since I'd been doing an ISA since 2010, why would I want to do that at 0.5%? And there I found myself buying some treasuries and some gilts at 5.5%. I just thought, oh, yeah, that looks decent. And I think that's just a useful point. That's where we are in the market right now, is, it's that risk-free rate. So if you're saying to me, Dean, right now, and this is perhaps, more of a global macro market perspective hedge fund approach, but, that's not Harleyford. We're real estate equity. We'll come on to that. I'm probably sat there going, there's some great fixed income products about in the form of treasuries, gilts, corporate debt, some great blue chip FTSE 100 stocks, yielding 8%, 9%. You've got Trig, the Renewables Infrastructure Group. You've got Aberdeen, LNG, Aviva. I've got no transaction costs at 0.5%. It's pretty compelling. And then I think if you supplement that, with allocations to new economy sectors, Yeah, where you come into, might be e-commerce. Amazon is a bit of a sort of Coca-Cola stock. You've got your Seagros of this world and so forth. That to me, makes a lot of sense, whether it be later living and so forth. And I think, across that approach, you can probably deliver a very, attractive risk-adjusted return. And that's not to say going through the public markets, I know there's an element of, if you work in property, don't invest in property, but I feel drawn to it because I have a deeper understanding of the markets that are going. So, Derwent, if I believe that ESG offices are the way forward, the public markets have completely oversold the stock, huge discount to now, 4.5% dividend yield. Oh, do you know what? That feels semi-sensible. And we've seen it in the UK logistics markets on the REITs. You can go and get Segro at north of 4% dividend yield, big box, which is long income, inflation linked, looks pretty sensible. And then you've seen with Warehouse and Urban, they get taken private and you've got 25-30% bump in the share price because there's a lot of M&A activity taking place. So you can get it there, for sure. I think if we then move on to a UK real estate perspective, again, Harleyford is UK real estate equity. It's not UK real estate debt. The debt is very attractive at the minute. A lot of investors and LPs, they want debt because they can lend it to you at 60% in the capital stack and generate an 8-9% IRR, chuck in some back leverage and some loan on loan, some very sensible, sound structured financial engineering to deliver a 10-11% IRR. That feels pretty compelling, against real estate equity, where you could be finding 5-6%, 6% yields, high transaction costs, and quite a lot of work to do. But we're not UK real estate debt, and that brings us on to UK real estate equity in that regard. And from a Harleyford perspective, we absolutely do see value, and no one's really talking about distress in the market. And I wouldn't call it blood on the streets. Maybe we've got like 3 levels. I've got stress, de-stress, and blood on the streets. We don't have blood on the streets. I think that's more representative of maybe 2010, 11, 12. We do have stress. Stress definitely exists. Yeah, the explosion in interest rates, and debt was taken in 2020. If you borrowed money in June 2020 on 5-year term, it's maturing now. Worse, if you borrowed money in June 2022, top of the market, if you bought something then peak of the market, and 3-year money, it's maturing now. And 7 of the 8 off-market deals that Harleyford have done are debt maturity led. So there's a couple of great opportunities at the minute. And one in particular is just being able to get your hands on product that you just shouldn't be able to get your hands on. Stuff that would typically not trade for 10 or 20 years because you'd never sell those assets, Park Royal, Trafford Park. So there's a compelling opportunity here to get into the last mile space where you've got the growth of e-commerce. And what I quite like about the growth of e-commerce, so it's running at 20%, 26%, 27%. It's just through the evolution of time that's going to increase, because you've got people, God bless their souls, passing away that didn't do their shopping online and never will do. But then you've got this new generation, the Gen Zs and the kids that are being born today that will only know buying online from the age of 10, from 10 onwards. So you're inevitably going to see this continue to increase. And consumers want their goods quicker. I want it now. I want it the same day. So with that, you're going to get this additional demand. It's not going anywhere for last mile delivery and best in class warehouses that are land constrained. Okay, so here we have an interesting opportunity where the tailwinds are there for urban logistics, and you've got more sellers than there are buyers, and the opportunity to pick off some trophy assets. So we are very comfortable continuing to play in that space, and I think a lot of those trends, they follow into Europe as well. And actually, you've got a lot lower cost of debt finance on the continent, probably 200 basis points, which offers another level of attractiveness. But Harleyford, we want to walk before we can run. So if the opportunity presents itself to move on to the continent with the right personnel, that's something we'll look to pursue. Now, outside of the urban logistics sphere, which is a subsector of the wider logistics market, but I think that's where we have the highest conviction and continue to do so. ESG offices is interesting. I just think it's been oversold. And coming back to that thesis that investment markets should follow the occupational markets, we have had 4 years of double-digit CAGR on ESG offices, best-in-class offices in really good locations, Yeah, the demand is absolutely still there. Yet the investment markets don't want to touch offices. They call it a bit of a, it's definitely not the flavour, particularly with what's happened in the US and the working from home movement, but that is starting to change. So if you can be picking these things up at like 7% and getting double-digit rental growth, I can just see that market beginning to polarise over time, where you've got offices and then you've got ESG, best-in-class offices, and institutional capital starts to come back. To me, it just looks cheap, and I think it's a compelling proposition. So again, Matt, if there's anyone out there that has got lots of experience, best in class in the office space, please reach out to Matt, and perhaps he can help broker a conversation. And then later living, I think, is interesting as well. So if you were giving me 500 million. I think, I'm not going to pin my tail on the donkey in terms of, exactly how that would be divvied up. But I think, across those three sectors, I'd be starting to make inroads into later living. I'd be starting to pick off some offices, and I would be building a best-in-class platform of urban logistics assets with a view to expanding and rolling those themes out onto the continent.
Dean, you've been a very difficult man to pin down to get you on the podcast, but it hasn't disappointed, and I'm absolutely thrilled that you've joined me. Thank you so much for sharing a little bit about your background journey. You've clearly been very driven. You've known what you wanted for a very long period of time, and crucially, you've gone out and actually done it, and you've got it. And a mutual contact of ours, when I was talking to at MIPIM, was saying Dean will not stop until he's worth £100 million, and I can believe it. And with that whole hedge fund, when there's the Dean Harrison family office set up, I can see you allocating your capital very thoughtfully to a broad church of sectors and being very, very successful. So thank you so much for sharing a little bit about your background journey, how you see the market. I would love to continue talking to you, but maybe we can find another time to do that for round two.
Well, thank you, Matthew, but I'll be keeping my feet firmly on the ground and keeping my head down and keep doing what we're doing. So thank you for your time.
Hey, quick one from me. If you enjoyed this conversation, do me a favour and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.